Okay, investors, this week, the Halo trade versus AI infrastructure, why a barbell portfolio may make sense to you. So, what if the best opportunities today in the stock market sit in two extreme areas? On one side, the ultra economy, asset heavy, durable businesses. On the other side, cutting edge AI infrastructure driving the next cycle. Today, I break down what our Oak Harvest team has been thinking. We've talked about the AI trade for over a year now. But what about the newer theme trade that's been talked about in the financial press, the Halo trade? What is the Halo trade? Halo stands for heavy assets, low obsolescence. What does this mean? Wall Street is famous for catchy acronyms, the Mag 5, Mag 7, REITs, things that are short and grab your attention. Think of businesses where the assets are hard to replicate. The useful life of those assets is long and the disruption risk is generally very low. These businesses tend to have four characteristics. First off, they're capital intensive, real assets. Think of pipelines, railroads, and energy infrastructure. Number two, they have long duration cash flows. These are often contracted or regulated revenue streams like utilities or toll roads. The third point, low technology disruption risk. Things like steel, electricity, and transportation networks don't get replaced overnight. Finally, fourth, pricing power tied to inflation. Then you have rate and pricing structures or commodity linkages that actually benefit from higher trending inflation. So investors' examples of Halo sectors tend to be like midstream energy, utilities, industrials, materials, infrastructure, and mining. Why investors are revisiting Halo now? Well, interest rates are structurally higher and look to be higher for longer as inflation remains somewhat sticky. So the durability of earnings matters as much, if not maybe more than growth promises. The second side of this, the AI infrastructure trade. Now let's go back and contrast this with AI infrastructure build-out that Charles and I have discussed for about a year now. This trade is defined by massive capital spending, short innovation cycles, high growth expectations, and generally, winner takes most dynamics. Key areas in this area, semiconductors, optics providers, cloud data centers, power demand, and network infrastructure. And remember, investors, it's most likely not early economic cycle anymore. We're in an acceleration phase in AI spending where demand is real, revenue is scaling, but valuations are already starting to reflect optimism in this theme, particularly in the private equity markets. So how do we compare these two, Halo versus AI trade? Briefly, Halo is categorized by physical assets, things you can touch and feel with low obsolescence, stable cash flows, and generally lower volatility both economically and in equity markets, compared to AI and its digital infrastructure, intangible assets or high intellectual property content, faster innovation cycles, higher growth, and much higher volatility. The key takeaway being, right now, Halo might provide more stability and income, while AI provides more growth and upside. Right now, maybe they are complementary. Some examples of each, where the Halo trade tends to show up in the stock market: energy infrastructure, pipeline storage, LNG facilities, electrical utilities and grids, transmission networks benefiting from a rise in power. Other areas, railroads. Those are irreplaceable freight systems with pricing power. More areas, basic materials, cement, steel, and construction inputs. So where does AI infrastructure show up? We've talked about this a lot the last year. Semiconductors, AI chips, and memory. Data centers, hyperscale compute facilities, electrical equipment, transformers, cooling, power systems, networking, fiber optics, data transfer, and connectivity. So while Halo might support the physical economy, AI would support the digital economy. So a barbell portfolio means owning both. So why are we looking at this? A little bit because the macro backdrop now. Right now, economic growth is slowing but still positive. Inflation is sticky around 3 to 3.5%, or short term, much higher with the recent oil spike. Interest rates are higher than the last decade as we exited the zero interest rate Fed policy, but flexibility in policy is right around the corner. Overall, market valuations are higher than average, with some AI themes being elevated, but Halo theme being more reasonable.
Okay.
So why would a barbell portfolio make sense now? A barbell strategy means both themes, owning durable assets and high growth themes. Why it could work now is macro uncertainty remains high and the world is getting more polarized and insular. The two themes have different interest rate sensitivities, while they have wide valuation dispersions and different return drivers. In Halo, think cash flow, income, stability. In AI, think growth, innovation, and upside. A portfolio that holds both is one, or maybe Halo anchors the portfolio and AI drives upside growth performance for now. So, investors, markets are not one-dimensional and your portfolio shouldn't be either. We currently have an AI investment boom and a resurgence in real asset value investing. Things that hurt if you drop them, things that you can hold. Our bottom line right now is Halo offers durability and usually some additional income and diversification, while AI offers growth and upside. You don't have to choose just one right now. In the way the economy sits, you probably shouldn't. Intentionally owning both may be smarter equity investment strategy today. Bocarva's guidance remains consistent. Stay disciplined, stay diversified, stay focused on long-term objectives. Whether your priority is growth, income, or a combination of both, our team is here. Whether your priority is growth, income, or a combination of both, our team is here to help you plan for your family's financial future, no matter where you're at in your career or in your retirement.